Hi, and welcome to this week's market presentation. Latest news. In the latest developments regarding the war in Ukraine, European leaders joined President Zelensky at the White House to meet with President Trump. With very high expectations coming into this meeting of real progress being made on a peace deal, the reporting indicates that limited progress was made, with both Russia and Ukraine remaining at an impasse. On the Ukrainian side of things, President Zelensky once again reiterated Ukraine's position that it will not cede any additional territories in eastern Ukraine. On the other hand, Russia continues to be adamant in their position that they will ask for those territories in exchange for an end to the conflict. One area of progress was the announcement and the reporting that firmer security guarantees for Ukraine backed by countries such as the US and European countries appears to be gaining momentum, with more statements confirming the reality of such a promise. However, uncertainties remain, particularly as to what the role of the US would be in ensuring those security guarantees, especially following President Trump's statement that the US would not put US troops on the ground in Ukraine in any case, instead hinting at potentially offering air support instead. Even Russia appears more open to firm security guarantees from Western countries for Ukraine, as long as Ukraine remains, quote, neutral and militarily not aligned. Following the meeting between the European leaders and President Trump announced that he is organizing, trying to set up a meeting between Putin and Zelensky to make further progress on a peace deal, and stated that he is giving Russia 2 weeks before additional sanctions or tariffs are introduced if no progress is made. Then moving on to the U.S. economy. At the annual Jackson Hole meeting of central bankers in the U.S., Federal Chairman Jerome Powell, in his speech, provided stronger signals that the Federal Reserve is prepared to lower interest rates in response to the slowing U.S. economy, as highlighted by the slower GDP growth in the first half of the year versus last year, and in the relatively anemic job growth the U.S. economy has experienced over the last 3 months. Financial markets reacted positively to the speech, with both U.S. stocks and bonds rallying as expectations of an interest rate cut at the Federal Reserve's next meeting in September raised to 89%. On the other hand, the growing signs of a slowing U.S. economy weighed down the U.S. dollar. Weather. Looking at the weather forecast, temperatures across Europe, which are expected to remain above average over the beginning of this week, are expected to cool down as we move into the middle and the beginning of next week, particularly across Western and Northern Europe. Eastern and Central Europe is expected to see an increase in temperatures through the middle and end of the week, with above average temperatures in the area. Precipitation is also expected to pick up across Europe over the next 4 to 6 days, and particularly at the beginning of next week. Then in terms of wind speed forecasts are expected to pick up, particularly in Western Europe over the middle and late this week. Lastly, look at the Atlantic tropical weather outlook. Nothing much of note, as currently we're only seeing a tropical storm named Fernando there in the mid-Atlantic, not threatening U.S. LNG exports to Europe, and currently a relatively lower chance of another cyclone forming there in the Caribbean. Macroeconomics. Looking at the latest inflation figures here, we note the stable inflation situation in the euro area, with the fight against inflation having moved in the right direction. Year-over-year inflation remained unchanged at 2%, with core inflation just slightly higher at 2.3%. On the other hand, inflation figures in the U.S. continue to deteriorate, particularly looking at core inflation, which rose to 3.1% as of July. The total inflation rate stood at 2.7%, which, while having not increased in July, certainly did not move closer to the 2% target set by the Federal Reserve. Crude oil and LPG. Crude oil markets moved upwards over the past week, namely on the back of the disappointment regarding the discussions and negotiations between European leaders in the US and with Russia over the last couple of weeks, which showed that an end to hostilities in Ukraine and a permanent peace deal is further away than previously thought. The prospect of additional sanctions or tariffs against Russia's energy exports further adding to higher tightness expectations in the market. On the other hand, limiting the increases in the market was the continued improvement in the supply outlook on the back of OPEC Plus keeping steady with their production rate increases, with expectation of an increase of roughly 550,000 barrels per day by the start of September.
Natural gas.
Moving on to natural gas prices. Natural gas prices saw an uptick over the past week, pushing prices up to the highest in over 2 weeks. The uptick in natural gas market is very much a response to the disappointment regarding the peace negotiations to end the war in Ukraine, as an end to hostilities appears further away. The prospects of additional tariffs, as with crude oil prices, further led to tightening demand and supply expectations moving forward. In terms of storage levels continue to gradually improve over the past week, now just under 75% as of the end of last week. And while storage levels have continued to increase, the slower pace of increases over the past week is adding some concerns regarding the state of storage levels in Europe. The ejection rate weakened week over week, now moving close to the average over the last 12 years, and certainly below the highs that we saw in 2022. The slower injection rates has also led to the storage deficit versus the previous year to stabilize around 16%, not tightening further. Overall, gas storage levels, while remaining around 75% on average in Europe, lag behind in Germany, who currently stands at 69%. Overall, while given current injection rates, we're still on pace to reach the 90% target set by the European Union ahead of the winter. We're certainly getting closer to the limit in terms of meeting that deadline, raising additional issues and adding some upward pressure on the market. Looking at total supply and demand, total demand remained relatively stable over the past week and very noticeably at the lower end of the past 5-year range. On the other hand, total supply saw a slight decrease week over week, primarily driven by a drop in Norwegian gas flows, which, as we can see here, remains the larger source of natural gas into Europe, with LNG sendouts a close second. Taking a closer look at the European gas supply mix, we note that decreasing Norwegian flows as the Norwegian gas infrastructure begins its autumn maintenance period. Flows are expected to drop further in the coming weeks, and while this maintenance period has been expected and has been priced into the market, concerns that additional maintenance needs will be discovered and as such flows will remain lower for longer are adding some volatility and concerns to the market. LNG sendouts did uptick over the past week in response to the decrease in Norwegian gas flows, but given the price competition with Asian consumers for LNG imports, it will be important to see how the evolution of LNG sendouts evolves in the coming weeks. Overall, the uptick in natural gas prices in Europe did help narrow the premium versus Asian consumers, and given the uptick over the past week, U.S. LNG exporters continue to face slightly higher profit margins shipping to Europe than Asia at this time.
Coal.
Moving on to coal prices. Coal prices reacted in a similar fashion as natural gas prices, moving upwards over the past week, particularly for the European market, as the uptick in gas prices made coal-fired power generation more competitive, leading to additional demand expectations. Coal stocks at ARA terminals remain at multi-year lows for this time of year, as you can see here, but have nonetheless been increasing over the last few weeks. Even though overall stocks are at a lower level on an absolute basis relative to current demand for coal across Europe, we're at relatively comfortable levels, leading to the limited upside in the market. EU and UK emission allowances. Moving on to the emission allowances, here we see some additional upside as well for both the European and UK markets over the past week. Here, the influence of the disappointment regarding the outcome of negotiations to end the war in Ukraine also led to an uptick in carbon allowances, particularly as it moved up natural gas prices, which then led to some increase in demand expectations for the more polluting coal-fired power generation. Secondly, as we near the compliance deadline of September 30th, we are going to see additional buying demand in order for those market participants to settle their positions. In terms of overall emissions and limiting further gains in the market are the fact that power sector emissions remain at the bottom of the range over the past 5 years. Electricity. Moving on to electricity markets, we see a similar evolution as with natural gas, with prices moving up week over week. The increases were most noticeably felt in the shorter term, with the last quarter of 2025 seeing a nearly 5.6% increase week over week. The frontier saw slightly more modest increases of just 3.6%, with the increases moderating as we move further along the curve. The evolution across European countries and markets was very much similar, particularly over in Western Europe, with most markets seeing an uptick in the price level week over week. Over in the Nordics, we saw some of the bullishness that we see in other markets be somewhat limited by the weather forecast improving the hydrological outlook in the region. Moving on to the fundamentals, total demand for electricity across Europe saw a slight downturn over the past week, owing in part to the temperatures over the past week, which helped lower overall cooling demand. Overall, both total grid demand and residual load remains at the bottom of the range over the past 5 years for this time of year. In terms of the European supply mix, well, we want to highlight the fact that the share of solar power generation has not yet peaked and continues to push weekly records lately. At the same time, the satisfactory levels of nuclear power generation out of France has helped keep the share of nuclear power generation at higher levels. On the other hand, the poor performance, particularly of wind and hydro, has led to a higher share of fossil fuel power generation as a response to the overall demand levels. Looking at nuclear power generation, we see French nuclear power generation at the highest levels over the past 5 years for this time of year, remaining relatively stable over the last few weeks. Nuclear power generation across all of Europe obviously remaining below the average given the retirement of nuclear power capacity across Europe over the last few years. In terms of renewable power generation and fossil fuel power generation, we see that stability in the output for renewables, while the downturn in overall power generation has been due to a slight decrease in fossil power generation, which remains at the bottom of the range over the past 5 years. The stability in renewable power output has been due to an uptick in wind power generation, which compensated the decrease in solar power generation, as you can see here. In terms of fossil and biomass generation, we see that decrease, particularly in fossil gas-fired power generation, as a response to the lower overall demand. In terms of hydro reservoir levels, we see that across several European countries, we are seeing a worse current hydro level compared to the past 10-year average, particularly looking at the Nordics, which have gone from a very high level of excess storage levels compared to the average to now very close to average, particularly in Norway and Sweden, and below the average in Finland due to the drier weather we've had over the last couple of months. Hopefully, the weather forecast will improve the outlook in the region. Then lastly, looking at the price evolution of guarantees of origin, we note a sharp bearish price evolution, particularly when we look at the 2025 and 2026 production years. Here, the outlook for renewable power output in the second half of the year has brightened, leading to an increase in the supply outlook for guarantees of origin. On the other hand, demand expectations are expected to grow in the coming years, hence the more limited decreases that we see as we move further along the curve. That covers this week's market presentation. Thank Thank you for joining.